have any volunteers. If we don't have any volunteers, I know we have ETHWarsaw volunteers. Don't read them out just yet. You just have to like lift your hand up and show the risk.
Anyone else?
I'm sure that Krzysiu Urbański wants to show up the risk. 2 more? We can do 1. We can do 2 more. We have the chairs. Oh, what's out the chairs? Come on, work with me. There are prizes included. 1 more and 2 more. So, I think right. Right, go with right. Perfect. I think we can start. So I'm going to start by welcoming my amazing panelists to the stage. Let's start with Anna from Legaichain. Then we have Kris from Spark. So we have Nikola. We have Nikola from DragonSwap and Piotr from Stablewatch. Wait, how many mics do we have on stage?
4.
4? And we need to hand over 1 to Stash.
We're gonna share.
Nikola, are you sitting on the mic there? Ah,
Thanks.
we missed 1 mic. Did we lost 1 mic?
Is someone sitting on it?
Oh, I am
yeah,
sitting on that.
sitting
Yeah, I'm. Well, here you go.
Okay,
Okay, perfect. We can start. So, since we're gonna spice it up a little bit later on, then let's start simple, and let's do a round of introductions. And I want to know your the role you play in the stablecoin ecosystem. So, tell me your name and tell me what do you feel is your particular role in the stablecoin ecosystem. And let's start with Anya.
Okay, so I would start with the sentence that my opinion about the stablecoins, it's mainly about the political game, and especially in Poland. So regarding these 2 main legal frameworks and approaches, we still have something new to deal with. But as you can see in Poland, we haven't still made the same approach regarding Mika. So I would describe the latest trend about the stablecoins and about the Mika, that we still need the initial stage about the regulations and about the main framework to see what next steps we should consider. And we still have to remember that stablecoins and the general crypto market isn't something typical, like the typical financial market, and it still has to remain with the cryptocurrency tendency. So it's not about the typical financial market and typical financial regulations. Of course, we have to regulate it, but regulations should help cryptocurrencies, not to block them.
Perfect. Anya, so you will be in our like impromptu Dungeons and Dragons game, like stablecoins and dragons. You will be the guardian. That's the role for the.
I will try.
Perfect. Kris, what's your role?
Hi, so I'm Kris. Currently, I'm a CTO at Phoenix Labs, contributing to Spark.fi. Previously, I was working at Maker Foundation, so I've been involved with stablecoins for years. And I guess my main role, I guess Spark's role these days is like spreading stablecoin liquidity across multiple chains and protocols. Mainly, we're focused on USDS, so the new Skies stablecoin, DAI successor, but we're also dealing with USDC, Tether, and others.
So you're going to be the alchemist, spreading liquidity.
let's agree to that.
Okay, Piotr, what about you?
Hi everyone, happy to be here. I'm Piotr, founder at Stablewatch. So what we primarily do is to help all of the greedy people understand what are the best yields when it comes to stablecoins and how to utilize them. And what's even more important, to understand all of the risks which those products inherit with their mechanics. On the other side, with projects, we work to help them explain better to their users how they work, pretty much. So we do a lot of risk and research stuff at Stablewatch.
So you sound like a sage in our game, like the owl. Perfect. And that leaves us with Nikola. Nikola, what do you think is your role there?
Hi, my name is Nikola. I'm a co-founder of DragonSwap. So I feel, we're in a weird stage where first of all, there is a lot of stable coins, and it's super hard to differentiate what's staying behind of each other. They're like differently also. Some are dollar backed, some are algorithmic, etc. So I feel there is a lot of uncertainty still. What's how things work, especially with the yield-bearing stablecoins. And what we need, in my opinion, what's currently broken is we need them to move faster. We need to be able to move faster stables across L1s and L2s. And in my opinion, currently the biggest use case is definitely seizing yield and accessing money faster.
So you kind of want to be the game master, like push people in the right directions, maybe have them invest in something. And so you're stepping into my shoes a little bit. Cool. Thank you so much for the intro. So overall objective for us for this panel is not really to talk about how amazing stablecoins are. I think all of us here have used stablecoins, are actively using them, working in that space, where they've somewhat melded with our day-to-day lives. I'm sure all of you have some USDC on your wallet. You probably have some locked in one of the vaults. You're probably not aware of that. There's a lot of people who are not aware of the fact that they're actively using stablecoins when using those giant payments protocols such as Stripe. So we are already using stablecoins. I don't think we have to talk about mass adoption for stables because we're living it. This is mass adoption for stables. Like the moment when they become invisible, the moment when Western freaking Union decides that they want to send remittance in stablecoins, that means we're already there. Hooray. I think I had a talk about stables like 2 years ago, and we were discussing what would it mean to have global mass adoption. And I think using them for remittance by a major remittance platform was one of the checkpoints. So I think we're there. So right now, let's focus on the downside of that mass adoption, which in my opinion happened very, very quickly. So we went from something that was, generating big volumes, but still relatively niche and typical to crypto market. And Kris can attest to that stables have been present in DeFi for many, many years. Now they're penetrating into not even TradFi, but to actual just regular day-to-day finance. So they're already in there. They're already an important part of financial infrastructure. Let's see how they fail. Let's see how we can make them break apart. Let's see how what would have to happen for them to fall catastrophically. So what do you think? And this is, guys, you have the, my dear audience, you have the sheets of paper with different risks. Feel free to lift them up whenever you feel like it. This is entirely up to you. If we don't have anything, we're gonna leave this for the question slot. But let's start with with asking our panelists, what do you think what would it take for the stablecoins to fail catastrophically? And let's start with Nikola.
Okay, thank you. So I think there is a couple of major failure points here, which is either liquidity impairment or basically, just not being able to convert from stable to fiat, which I think is the biggest one, and depegging, obviously. In my humble opinion, those three are currently the biggest pain points because we can, witness their either confidence shock with depegs and not being able to basically halting the redemption, and definitely the the thing I mentioned before, which was for the just like depegging and liquidity impairment, which is kind of also very important. As like a lot of, I would say most of DeFi protocols rely on them, and a lot of them are assuming without concrete liquidity verifications that they're worth $1. I'm speaking about the stable ones, not a yield-bearing stable coins, etc. I'm speaking about USDC, USDT, etc. So I think those are three main points of failure.
The redeemability part is both the biggest advantage point of a stablecoin, and I think one of the biggest threats associated with that. And in traditional finance, we all know the term bank run. So, like, if there's some panic at the market, oh, we have a bank run happening. So if there's like a lot of panic on the market caused by like a political event, war, pandemic, whatever, like just about anything that happened in the last 5 years, that influences the exchange rates, that influences monetary policy. And I think that stablecoins start to behave very similar to actual traditional finance. And Anya, it kind of relates to the fact that you can also have a bank run on stablecoins. It's not an obvious thing, but you can have that.
Yeah, in my opinion,
Anya, just mic a little bit higher up.
okay.
Perfect.
In my opinion, as I said before, we should still remember that there is a really small difference now. I would say, like the stereotype of stable coins, which is still comparing stable coins to traditional e-money tokens, and even Mika has not the strict stable coins definition. I mean, there is a discrepancy between definition of the e-money tokens mentioned in EMD2 and also used in Mika directly. So I would say that we should still divide these two approaches, and in general, I would rather compare today's situation and stable coins to still having the connection, the strong connection to traditional banking system, to traditional payment system. And from the legal perspective, we still have to depend on traditional financial system because, of course, we are starting with regulations. We have MiCA, fully implemented or not fully implemented, but we have of course Genius, but we have still traditional payments and traditional financial system basis we have to follow, unfortunately or fortunately, it depends, because I would say that this is the initial stage of general understanding of stablecoins and general understanding of cryptocurrencies, also from the legal perspective, because we still have to learn how to treat stablecoins, how to treat crypto, non from the traditional banking system, and we have to deal with traditional tools with non-traditional stablecoin meaning, right? So
that go on, Piotr.
Yeah, I actually think that it's not that big of a risk when it comes to a bank run. Like, we've seen it once with like Silicon Valley Bank a few years ago, but I think that the big impact on that situation was that Biden administration was actually working on choke point to zero operation, right? So normally when something like this is happening, Federal Reserve gonna come and save the bank and everybody who's involved in the business. But somehow US didn't really want to deal with crypto, and that's why they haven't provided any help to SVB. But now with like new people in the government, also in EU, totally new approach to regulation, we see that at stablecoins, we don't use the fractional reserve system. So like if you go to JPM Chase, like PKO, you give them 10K deposit and there's 100K credit created out of this. With Circle or Tether, this is not happening. Actually, it needs to be backed one-to-one. And in some jurisdictions, some coins are banned at the moment because the treasury is not that transparent, so regulators don't know if there's enough T-bills or whatever else is sitting there. And that means that if a bank run gonna happen, and if regulators did a great job to actually ensure we're safe, nothing should happen. So now the question is here, how great policymakers will help us establish some boundaries to make the system clear. But I think that a lot of good stuff is happening for the payment side.
Regarding traditional financial system and banking, I will give an example because, as you probably know, in Poland we haven't still implemented MiCA fully. So here is a situation. I'm dealing with a lot of clients. So of course, we are having a valid VASP license in Poland, as long as MiCA is not implemented. So we really need to start with the cooperation between traditional payment solutions and crypto solutions, because for now Polish banking system is not cooperating, and we are having still a lot of problems with basic cooperation, like opening banking accounts for VASPs. So this is a crucial point in my opinion, because if we would like to make next steps, we should start from the very beginning and from scratch.
If I may add one thing, I think like every stablecoin discussion should be kicked off with just discussing different types of stablecoins, right? Like others already hinted on it, but basically I like to think that there are three types of stablecoin. We have like these peg coins that basically hold cash and cash equivalents in the banks. So USDC or Tether to some extent are perfect examples of that. Then we have crypto or mixed collateral stablecoins like USDS, DAI, I don't know, Go, and probably a few others. And these are like debt-backed stablecoins, often with like they kicked off with collateralizing with ETH or Bitcoin, but these days the collateral basket is like really diversified, right? And also includes like, I don't know, different trading strategies like ETHWarsaw style stablecoins. And then we have algorithmic stablecoins. Okay, I'm gonna get to that in a second. And we have algorithmic stablecoins, which is stuff like, you know, Terra, I don't know, Ampleforth, and these basically they don't work, right? But what I'm saying is that the bank run risks are totally different between all of them, right? Especially for like algorithmic stablecoins, they just totally don't work with bank runs, which we all saw with Terra Luna. And the other types of stablecoins, I think they are much more secure against bank runs, like especially like, you know, the first type, the cash and cash equivalent backed stablecoins, like, you know, you have like plenty of cash in the bank, and then you have treasuries, which are also like, you know, pretty safe, even if you need to sell them. Yeah.
So for those of you sitting in the back, we had a card pulled with ETHWarsaw breaks. So let's try to figure out what happens if ETHWarsaw breaks. Kris, but also Nikola, I think I would like to have your insight on that.
Okay, I can talk a little bit about this, because we already saw some small issues with ETHWarsaw in the past. So, like, first of all, like ETHWarsaw, I think, and our risk team agrees, is fundamentally like safe product. You know, it's properly backed either by, you know, spot position holding some volatile asset, but then shorting the same volatile asset, which should net the exposure, the risk. But the truth is that Ethina can temporarily depeg, and I think we saw it. What was it, like a year ago or more than that? So these things can happen, but I think it's like important to realize that like the trading strategy underneath is like more or less sound, and hedge funds were doing it for years in the past. It's just tokenizing this strategy, and of course, like there are some other risks, like what if crypto exchange that Ethina logs money in gets hacked? And guess what? It happened a few months back. But turns out that Ethina also, and like similar projects, innovated a little bit in that direction, and they are not holding the custody of the funds is not held at the exchange. As far as I know, there's like a custodian that holds the money. And it's funny because Bartek raised a custodian failure card here, but I guess I can stop here.
Nikola, do you want to add anything to Ethina breaking? Because I know it has like the possibility of Ethina breaking for like various reasons has multiple implications on lots of DeFi protocols. This is like if it happens, this is like a major domino reaction right now, like Aave falls, Morpho falls.
Yeah, I would say there is. I mean, we would also consider Ethina very safe. I do agree that depegging is a big risk, and yeah, I think there. I mean, I don't feel there is like SPOF, like the single point of failure as is, but usually it's just cascaded. So one thing like just runs another thing, and then that cascades, and actually we're getting the domino thing. And I agree with that. Like as you mentioned previously, for the Silicon Valley Bank shit show a couple of years back, it's been the same thing where like USDC lost peg, it went to like whatever, like 70, 75 cents for a bit, etc. And I think that's a point where every single person who holds its whatever, if it's like 1% or 90% of the assets there, is like, is this actually safe? And like, if it happened once, why it can't happen again, right? So I think that's I mean that goes back to like single point of failure risks, where I do think like those things sometimes can cascadedly make a big shit show, even though there is a lot of like, I would say, funds and market makers who like very quickly rebalance things back. I still feel like if it even happened, it's a problem. So it's not a matter if we fix it or not, but it's not going to be fixable always. So I do agree with most of what you said, basically.
Yeah, I think big problem here in this discussion is that we comparing the mean of payment, like USDT, with a tokenized hedge fund, and this is why it's really hard to use the same measurement for like both of those, as it never gonna fit. So now when we're looking at stable coins, we think of everything in this basket, from payments to yield-bearing stable coins. But those are not stable coins, those are structured products, mostly working as a tokenized hedge funds with like $1 per share. And they do that because they try to inherit all of the benefits regulators already made for payment stablecoins. So this is why it's very hard to talk about that, because we should be talking about it like totally
separate things.
Different topics. Yeah.
I think there's some overlap, as in it's not, they're two different things. They exist and for different reasons and behave differently. But the fact is that they are bundled in together in various products, which is the USDC that you're using for payments is also omnipresent in DeFi. And there are like so many connections that we can see a situation where an event happening strictly in DeFi in synthetic stables can affect how the payment flows on the other side of the world in remittance actually happens. What is the value of that payment? Piotr, like with Stablewatch, you're right now measuring the like you're building the stats for stables, but I think going into risk predictions for stables is also one of the things. Do you intend to build something that outlines, like do like a TLDR version of a risk scoring for stables, such as L2B did for L2s?
Not like ultimate scoring, because actually if you try to do business and sell something and tell people they're like triple C, they're not gonna buy it, probably. So what we try to do is rather to highlight risk areas associated with all of those products, and we realize that it's like totally different work to do it for payments versus this yield-bearing space or like credit market. So what we try to do is we actually focus now purely on the yield-bearing stablecoins. Yeah. So there are quite a lot of risks involved here. The biggest problem is there is negative interest rates. So we're gonna cover that in a minute, I assume as well. This is actually good for yield-bearing products, because if the interest rates in US gonna go down, in last cycle there was no bridges, like no SPVs, no like legal ways to pour money from Wall Street into on-chain, and now Franklin Templeton, BlackRock or whoever else is not testing anymore, but actually using on-chain products, and mostly they're using stable coins and then some third parties helping them with DeFi integrations. So there's a lot of money market funds which not going to be able to produce any profit or any revenue if they're going to stay just with T-bills in the US. And I think that most likely they're going to go on-chain, and this is what everybody's preparing for. And Ethereum actually is probably the best positioned product for that, already doing a lot to catch that attention from the institutions. But there are much more really risk adjusted and very transparent products like SUSDS, for example, who are also really great position to do that. So overall, like low interest rates gonna just pump the market a lot, like 10-100x, I would say, in a long term, and it can really be like big carry trade between TradFi and on-chain. But still, there's like maybe 3 protocols which are very transparent about what's going on inside, and this is what we try to tackle at Stablewatch.
It's maybe not that directly addressable for yield bearing and the part that you're working on, but right now for the payment stables, we're relying very heavily on the proof of reserves, which is basically a non-existing thing, because it's in most cases this is like a PDF posted on your website saying, I have money, I also have money, I can print a PDF. And that kind of ties to the fact that we're with the very, very fast adoption of stables, we kind of like assumed the best, kind of like a good approach to those reserves, as in like we're gonna hold them. Like they're not yet audited, we don't have a proper proof of that, but we're gonna hold them, and that poses. I think there's somewhere there's like a custodian risk, saying that hey, yeah, you must you have the reserves, but what if you don't? What if you're lying about the reserves? What if there's some bad actors at play? And if you look at the structure of stables right now, especially the ones used for payment, they're all centralized. Like not even centralized. They all have like a single decision maker, and it does not take a lot for them to decide, hey, I'm just gonna do, I'm gonna do a rug pull on you because it's a good moment for me. So I don't think we're there yet when it comes to safeguarding those funds, even though Mika and Genius have listed out the requirement for the banks to custody funds. But I still think that the tempo at which we are seeing the adoption of stables in payments, in DeFi, in hedge funds is not really catching up to what we see among the traditional finance. And I know that this is, Anya, what you mentioned with payments, with banks refusing VASP holders' bank accounts. But it also means that stablecoins can be very susceptible to any political changes happening locally. And Poland has a very interesting example on that, and I'm going to let you take this one over.
Yeah, exactly. And I would also say that, of course, we have a lot of special requirements regarding Mika and Genius as well, but still we have no practice. We have a lot of audits, we have a lot of safeguards requirements, but still this is I would say, this is the draft, let's be honest, of the whole situation in Europe and US as well. So as you mentioned, of course, and as we spoke before, this is the political game. And as you can see, for example, in US, we have like a totally different approach 2-3 months ago, and now we like stablecoins. Now we have to regulate it, and also regarding Mika, and especially in Poland, I can see 100% different approach when we speak about traditional payment entities, and they have to fit in the new realm. They have to fit into new situation. And 1 year ago, there was a stereotype, especially in banking system in Poland, that stable coins and cryptocurrencies are something we have to be afraid of. And now there is a Mika, and we have to be compliant, but no one knows how to do that. And yeah, I think that there is a huge can you yeah, and we have to still be prepared that we have some policies, we have some internal policies in particular entities, but we still have no practical action plan. And we still have to depend on actual political game, because in Poland, we mainly haven't implemented Mika yet because of this political game. We have two different approaches. We have two different drafts. One of them is treating cryptocurrency market really similar to classical payment industry, and CASP is treated like another payment institution. And the second one is trying to save this independent approach. And in general, we have to wait. Just wait and observe the situation. And I can see another risk, because a lot of my clients are dealing with external partners who are asking about the Mika implementation in Poland, and they are dealing with the risk that in the future, if we will not implement Mika, we can be excluded from the market, from the business partners who implemented Mika, and that's the most important risk, I would say.
I think when you're referring to the lack of implementation, overall we can see that politics are super important in that particular game, and that very much leads to the global dominance of using stablecoins as a tool of global dominance of dollar. Nikola, do you have comments on that?
Yeah, there's actually two things I wanted to mention. One is regards what you mentioned previously about the attestations, etc. And I feel they do reduce debt, but the only instant instant redemption on streets is what's going to kill the debt about the stable coins. And speaking of this is exactly the topic I wanted to mention for the dollars worldwide is so I feel like if you ask 1,000 people who have stable coins, 99% of them will hold dollar-backed stable coins. What I feel is another problem is that's kind of a way that dollar gets huge exposure, even in Europe, where most of us are quoted to euros, right? And even by holding stable coins as an example, we're double exposed to, first of all, dollar is super volatile due to the politics. It's pegged to a couple of other currencies, but definitely not euro, which is kind of doubling the risk of why am I doing the business in dollars if I'm in Europe? Right, if I go now to Nike.com website and I'm buying it in US, it's going to be in dollars. If I'm buying in Italy, it's going to be in euros. I'm going to pay in euros and I'm going to get quoted in euros. So I feel that's definitely I feel that's the way dollar is getting a worldwide dominance. I mean, it has it already, but this is just kind of doubling down on that. But I also feel that's not sustainable on a long term, definitely because of even the local microeconomies that like people just don't want to be exposed to dollar. Like why would we pay all things in euros or like other European values, currencies, but like we're getting dollars, so we're getting a huge risk and exposure of dollar, which is really super volatile. Like, I mean, it went up and down like 10% more or less this year. So comparing to euro, like from 103 to 117 or something like that, which doesn't make a lot of sense as well. So I think that's another problem that's huge breaker for the mass adoption. That just like the reality is right now we're accepting this and we are fine with this, but I don't think any bigger fund or whoever is going to be accepting to turn its treasury from euros to dollars just so it can get exposure to stablecoin yields or something like that.
Yeah, who's getting paid in dollars? Like, who got kicked massively on the ass over the last half year? Yeah, I went through that as well. Like looking at your salary shrinking for no good reason, that's not really great. I agree that like the global dominance of US dollar for stablecoin is something that is a potential major risk factor, like something slowing down the adoption. On one side, you kind of wanted to have access to dollar because it's more like a better source or like better way to store your assets, especially in countries with high inflation. But then when you look at the macroeconomic policies right now, dollar is not really the best asset to do so. And with stablecoins, you can actually store your assets in some other currency, in some other stablecoin. We don't have a lot. I'm going to ask Piotr about the share between the US bearing and US pegged and non-US pegged. But I think we still have some, right? We have some alternatives.
But let me just ask how much risk you want to take. How much do you trust them? That's the main question.
Yeah.
Yeah, I'm not really sure about the ratio, but there's actually quite few of them, but there's not any one which would be really implemented broadly across DeFi or like Web2 payments or whatever, because there's no demand for that. I mean, why you'd actually hold any other currency than dollar? So where we use USD, it's like the stablecoin started being so used in crypto because traders needed to somehow have a like safe haven for their trade. So they were entering trade within Bitcoin or maybe some other altcoin, and the profits they wanted to roll back into USD, but not into US bank account or whatever other bank account, to use a lot of money on fees. So that was the first like big PMF of stablecoins. And later on, all of the like countries, like global south countries, emerging economies, where their currencies are just flooding and every year lose a lot of value, they want to have a dollar exposure, and there's much less of like compliance hurdles if they will be able to access that through stablecoin. And then the question is, where is the most liquidity when it comes to actually swapping those local currencies like Philippine peso, for example, or whatever else into USD? And it's not for euro or any other G7 currency. It's only for dollar and actually only for Tether in a few places. So I don't really see us using the stable coins, like local stable coins, like euro ones, very broadly, unless banks just gonna switch their infrastructure, and even we will not like get this in MetaMask or Rabi or whatever. It's just gonna be one bank sending to other bank euro, thanks to blockchain, and this is the only way why this, in my opinion, could work. And the ratio is like probably 99-1 at the moment. So there's a lot of local currencies, but there's really small market cap of them, though there is a really large volume because everybody wants to get into dollar.
If I may add one thing, despite the fact that euro-backed stablecoins are like very small compared to dollar ones, there's actually a little bit of innovation happening in that space. Like for example, Monerium provides like IBAN regular bank accounts that are tied with your Ethereum address, and every time you transfer money, like from your bank account to this IBAN, the euro E gets minted on your blockchain account, which I think it's pretty cool, and it works also the other way around. So it's like a very simple on and off ramp. Yeah, so there are some actually, some companies working on some innovation in that space. Even in Europe, it happens sometimes.
Yeah, but actually, like, I also use Holy Health, and I just lose money because I put USDC or USDT there, and they swap it into euro. So it's not that
I don't
useful.
spoil it for you. I'm fixing that.
Cool.
I cannot tell with what, but I'm fixing that.
And just to add something regarding the battle between USD and euro, also regarding Mika and this whole political game, we have the limitation about the non-euro stablecoin payments in Mika as well. So I have no idea how it will work in practice, because I think that the European regulator should consider this approach. It looks like we are afraid of something, afraid of dollar. I don't know, but I can't imagine how it will be implemented. So this is another kind of risk without any kind of practical solution, I would say.
I think there are some interesting implementations of non-USD stables. I didn't mention what I do, but I do non-USD stables for anybody interested. So on the non-USD stables, I think one part is that through like they function the same as any fiat-backed stables, but what they offer you is that if you have a developing country and emerging region, they usually have to have higher rates on the treasury bills because they need more money so you can get exposure to that in a much simpler way. So this is just about abstracting away the ops cost of getting a treasury bill in Argentina or Colombia, and you can actually do that via stables that are like somehow yield bearing, but not fully yield bearing. So I think there's a way to access those financial markets in a simpler way, and that kind of gets us back to like the initial premise of just using blockchain, which is you can build complex financial tooling without the ops burden that you usually have to take when purchasing a treasury bill from whichever country you want. So I think there's some interesting solutions in there, but I think I wanted to revert back and add like a global question there about stablecoin issuers. So with MiCA regulation in place and all of the EMIs, stablecoin issuers tend to look more and more like banks. They have the option to accept payments for you. They have the option to send payments for you. This is like an accidental setup because they have the regulation intended for crypto assets, but to be able to anything on the payments market, they also had to get the payment licenses. So you have like a very weird combination of entities, EMI entities and similar ones that have both the crypto assets regulation and the payments regulation, which gives them features that are incredibly like a bank. They can, like what Monerium is doing, Monerium can open up a virtual IBAN for you. So you can open up a bank account with Monerium. They can accept payments on your behalf. They can send payments on your behalf. And that starts to look increasingly more like a bank. And when you add the feature of them being able to create a wallet for you, of being able to connect that virtual IBAN to your Ethereum wallet, being able to natively connect to crypto, you have this really, really nice hack for all of the on-ramps, all of the off-ramps, hack that lets you plug in directly to the banking system. And I think MiCA and all of the regulation, the Genius Act, everything that followed in the world is basically positioning stable issuers as this unique plugins to banking systems. And right now, if we look at stable issuers, we can treat them as banking as a service, catering specifically to crypto people. And I think just realization of that is amazing because it changes, like we can build the SWIFT network just between the stablecoin issuers. We don't have to rely that much on traditional finance. We can move all of that entirely on chain. And it's still going to be connectable to banks. It's still going to be like the connection will be legitimized by actual proper regulation. And I think that very much changes where on and off ramps are positioned, where exchanges are positioned. And I think it's a very good setup. Like, people have been complaining about the regulation, but I think overall it's a new opening for us, and we can build. It's like we're being given a new set of tools to build on top of stables. This is an open question, so whoever wants to comment.
I can observe also a tendency to maybe treat traditional payment institutions who are trying to obtain a CASP license and trying to connect these two kind of industries more friendly than separate crypto exchanges or CASPs. So yeah, I totally agree. And maybe there is a kind of compromise to ensure traditional banking entities and traditional payment institutions fit into the new kind of ecosystem and start with this kind of approach to find a compromise between traditional ecosystem, and maybe it will ensure and involve this new approach into the general crypto ecosystem, and we will try to then implement more regulations for non-traditional payment institutions. And I can see that, for example, in Polish ecosystem, KNF, who is potential CASP regulatory, is having a mainly traditional approach, and the first MiCA draft, MiCA internal draft, was mainly focused on this kind of traditional approach. And yeah, I can see that it might be a new kind of compromise for starting with traditional payments approach with trust, more friendly approach, and then trying to find some next MiCA internal approach generation for crypto entities.
Yeah, after your talk, I realized we now work in fintech and not crypto anymore. But on more serious note, they also regulated as a payment providers, but they don't inherit any benefits of that, so they don't catch any upside in revenue. So all of those issuers act just as a funds. The only way they make money is through getting yield from T-bills and not distributing it further. And then the question is what else they can actually do, because there are much more players interested and much more far away developed to serve now with payments, like to replace Swift or whatever. I don't think Circle gonna replace Swift. So actually they have big problem, I believe, mostly because I believe they're going to be tokenized deposits sometime soon available. Like, why JP Morgan won't do that? And then there's like no sense in using USDC because you can't have a credit creation out of it. But from the JP Morgan coin, you will be able to do that. So all of those issuers made really big effort to bring crypto to actual real worlds and become fintechs, but I think that most of them are now bad positioned because of that, because now they don't fight with some other crypto folks, but they're gonna fight with JP Morgans of this world.
I think what you said about us no longer working in crypto but in fintech resonates very highly with me. I was at a panel yesterday about like importance of stablecoins in DeFi. I was like, but just FI. Just FI. No, it doesn't have to be DeFi right now. Like implications of stablecoin and finance right now is like big enough subject. And what you said about stables, like the stable issuers of yesterday or of now are going to be competing with the JP Morgans. I think it's something that can be the actual downfall, as in it gets, when it gets so popular that it's invisible. Do we win or do we lose? Like as a general crypto community, do we consider this final stage of mass adoption, or do we consider being overtaken? Do we consider being, I would say, acqui-hired?
Yeah. So I think there's also like possible positive scenario that while we switch from the old infrastructure like Swift, SEPA or whatever into settling all the transactions on chain, that means that the barrier to entry that market is lower. So actually it's not only banks with like under banking regulation can enter the space, but actually much more fintechs can start serving the same customers. And as the nature of like on-chain finance is that it's open, you can build whatever you want, you will see much more entities which gonna distribute this yield further. Because if you like to build PayPal, like from the tech standpoint, it's not that hard. You just need to have enough money to build it, but you can't replicate the network effects of it. So this is the hard problem, but it becomes much smaller when you're in the on-chain economy. So then maybe there's a scenario where all of the new entrants gonna push first some smaller entities like Venmo, for example, etc., to actually start losing their revenue through NIM and give out the yield to users, and maybe it can go up. And JPM also would need to do that, but I think there's a lot of work to achieve this.
I think we have still a lot of work, but like you mentioned that we still need time to get this tested, and like the fact that those major players are entering the space is both good and bad. Can be a good thing, can be a bad thing. But I don't think there's enough time to prepare. I think yesterday Stripe launched a chain for stablecoins, Tempo. Just a few weeks ago, we had Arc by Circle. I've mentioned my favorite team, Western Union, going into stablecoin payments. But we also have Robinhood with launching their app on Arbitrum. You have those major players going into that, and they're all gonna make a solid bet on stables. And I have two more questions. One will be a short one. Piotr, how many stables do we have right now?
Yeah, a lot. Yield-bearing ones, we counted more than 150. So the payment ones, I think it's also quite much above 100.
And what's the volume?
Yeah, I'm not really sure at the moment.
Okay,
I'll need to check our website.
Okay, go to Stablewatch, check the volumes. But my final question is, are they, it's a very simple question, are they too big to fail right now? Do you think the stables that we have, the 99% of the market?
No, it's like the M1, M2, like monetary supply of US dollar, domestic, so not like counting petrodollars, euro dollars, is much larger, and stable coins at whole, so also yield-bearing products and payment products together. At the moment, it's like 1.2% of M2, so it's really tiny for real-world economy still.
Nikola, Kris, Anna, any comment on that?
Just to sum up, as you mentioned, we actually have no time to prepare, and the main issue, the main risk, in my opinion, now is to change the general approach from crypto is something we are not tolerating to we have to implement crypto fully, and we have to start treating stable coins and alternative payment solutions as something which is a part of the general ecosystem, not the optional payment solution.
So are stablecoins too big to fail? I don't know, to collapse the whole world economy? I would say no, but to make a lot of people poorer, especially in this room, probably yes.
I think this is an uplifting summary for for today. I think it's good that we are facing mass adoption. I think it's good that we're already there with big customers going into that space, but we're nowhere near being as ready as we should be. We're still lacking the playbooks for any risk situations. We're still lacking the right arbitrage options. It's still not where we want it to be. So I think it's good that it's not yet too big to fail. We can still afford another stablecoin-induced crisis. We're hoping that it's not going to be the case. Let's not hope for another one. But I think we can still afford it, as in we're not that, the stables are not that merged into global finance so that this would collapse the whole economy. Perfect. Thank you so much. Stash, do we have time for questions? We have time for one question. Okay. David.
If you remember my name, that's good. So I got general question about stablecoins. So in nowadays era of MiCA regulations, big companies going into stablecoin games, is there still room for a little bit degen, DeFi only, legal but not MiCA compliant, maybe decentralized money, decentralized stablecoin, or is it too late, or is it not possible in your idea anymore?
There's liquidity and you can fork it pretty easily, and there's a lot of implementations. And yeah, I think that the Sky is also doing a really amazing job with the decentralized finance.
For not MiCA compliant stables, go to Kris.
Answer first.
That's all I said.
Yeah.
I'm not hearing.
I'm not a lawyer, so you need to ask lawyers about this. But we have one here, so you're in luck.
Okay, so I would say that we have to divide these two approaches. Of course, there is a room, but of course we have a traditional perspective, and we have a lot of entities who will follow this traditional approach. And for now, I would say it depends on the business model. And for example, a lot of entities, my clients are trying to run from Poland, from Polish regulations. But still, we have a few who are trying to fit into the traditional system, traditional legal Polish framework, even if we are not having it yet. But yeah, there is a room, but it depends what is the structure, what we would like to do, and what types of payments and clients we would have.
Amazing. Thank you all so much. Anna, Kris, Piotr, Nikola, thank you so much for the amazing panel. It was a pleasure hosting you here today. And thanks for the audience, and thanks to everybody who participated.